Hey guys, welcome to another Trade Genius podcast. Philip here with Bob Kula as always, and today we're going to talk to you about some of the stuff that's going on in the markets that you need to be aware of because it really is what's behind how this market continues to grind up, even when things seem bearish, maybe potentially us going into a recession. But we're going to explain what goes on and why this move makes sense in those terms, so stick around.
Trade Genius.
So, Phil, what we have here is a situation called the tail wagging the dog. And so, when you and I talk a lot of times on this podcast, the 800-pound gorilla is Fed liquidity, but he kind of has a friend. And his friend is the derivatives gremlin. And in a short period of time, the Fed liquidity is not moving up or down too much, the gremlin can take over. And since basically 2 days before the end of the year, up until Thursday, we've had the call buying gremlin in full regalia. And before I show you this chart, this is what happened in 2021. If you guys remember the Wall Street bet guys and GameStop and AMC and all these things where you have a small group of people with a lot of leverage can drive the direction of a stock price. And now we have here is a large group of people trying to influence many stocks at the same time in concert, and you get this chart. And what this chart is showing you is simply the option market flow. And you see when we went from kind of red into green here is basically, puts and calls being bought, open interest, the number of contracts that are available. And as you could see over time here, coming up to the present, they've been jamming the call volume much, much higher. And, some people will say, well, so what? What does that mean to me? Well, what happens here is that when you and I buy a call option, on the other side of the trade is a dealer, and that dealer is selling us the call. And so they like to stay neutral. They're like real estate agents. They don't want to get involved in the transaction. They just want to capture a commission. So they immediately hedge their position by going, long or short the shares or long or short futures contracts. And so if you get enough people driving calls, and people know calls are a fraction of the price of the shares. So if you get enough people to push your calls through, and especially when it what's called shorter dated, meaning closer to the time they expire, you can get oversized moves in your direction. And that's exactly what we're seeing here. Fed liquidity has not been cooperating. We know the CPI number came in a bit hot. We know the Fed is hawkish. So knowing all those things is that you would say, hey, the market shouldn't be driving higher like it is. But this is why it is. So the downside to this, Phil, is that you can only keep laddering on more and more contracts because you're going to hit a point where the contracts are too expensive, and then those contracts unwind. And when you see those green bars on the chart start to go down, well, the market's following it down because the market makers or the dealers don't have to hedge anymore. They can release their long positions as these contracts dry up. And so then you end up with you going from a good guy to a really bad guy, and that's what's happening here. And I'll take a stop here only because I'm going to probably cough. I'll give you the phone here for a second.
Yeah, so we saw this in 2021 quite a bit with some of the names that were the meme stocks, right? AMC and GameStop, and so it's really no different. And how that ended was basically the liquidity, the Fed liquidity that we've talked about and shown you guys a number of times, and it's in the newsletter daily, basically dumped a lot, went down quite a bit. And you can think of that as that's the big great white, okay? So you have these other smaller dolphins and whatnot chasing this market up, but ultimately that bigger fish is going to come and take away what really drives this market, because without that liquidity, the derivatives can only do so much. And ultimately, while the derivatives can currently wag the dog, so to speak here, that liquidity runs the entire thing. Okay. So if there's no liquidity or it drops dramatically, that's when this is going to end. And that's exactly how it ended going into the end of 2021, going into 2022, and then we dumped. So we would say, like, be cautious here. And Bob worked up another chart here of the SPY. And if you guys aren't, some of you, I'm sure, know what the SPY is. If not, it's just the ETF of the S&P 500. You buy the SPY, it trades like a stock, and essentially you're trading with the entire S&P 500 basket. And it's similar to how the futures traders trade the ES futures, which is the futures derivative of the S&P 500. But if you don't have a futures account, you just trade the SPY. And a lot of what we talked about yesterday about zero DTE options, this is where the playground is for all that stuff, and why we're seeing probably an increase in the green line on that previous chart with all the call activity is directly tied to what we're seeing going on here. And I'm going to kick it back to Bob, because he's going to explain to you what's on this chart and why this isn't a time to get super over aggressive to the long side here, buying up here.
Yeah, so if you look at the SPY chart, is the, we always reference our algos, and one of them is telling us whether we're in, we're heading into resistance or we're heading down into support. And as you can see here is that we basically had a flip of momentum, and we have a price action driving up to, and this is a 4-hour chart, which is a good chart to use for swing trading. And we went ahead and today, actually Thursday, flashed a sell signal on the 4-hour. You see that red triangle above that gray bar, that's right above price. And so we have a situation here where it's going to take a lot of energy of new buyers coming, which we don't have new buyers coming into the market. We just have shorts that are covering their positions. And so we have a situation here where you need new energy to drive the price up and over that, and what we call it flipping the range, getting it to a higher level. And so that's an area where if you are long, you should have been getting out on Thursday and congratulating yourselves on really good move. And if you look at the bottom pane, this is a visual interpretation of one of our other algos on the heat side. It's basically starting to roll over too. So when you see one of our algos starting to lose momentum and another one coming up into resistance, you should be waving the white flag saying, I'm done, thank you very much. And it's something you should be really concerned about. The only other point that I'll make, and it doesn't mean there's a market crash, it just can pull back to support and go higher. All I'm saying here is that this is telling you that you might have good enough, okay? And another thing is, I didn't have a chart for this, but it was just astonishing while I was waiting for Phil to turn on our podcast recording, is that I was reading on Bed Bath & Beyond, and it's a stock that's going to go bankrupt here within the next 60 days. Last Friday, you could only trade an option by appointment only. Okay, that's how indifferent everybody was to that stock. On Thursday, they traded 71,000 contracts, and most of these are call contracts, and it just drove the price higher. Basically, it was designed to scare out the shorts, if you will, that are holding onto that position short to be able to get maximum profit from a bankruptcy filing. And it's not just Bed Bath & Beyond, it's AMC, it's GameStop, all the companies that have been struggling of late, Tesla, they've just been jamming these call contracts to shake people off, the fundamental traders, shake them off of a belief that these prices are overvalued. And so when you have what's called junk going up at the same time everything else is going up, it usually doesn't end well. So we're probably very close to a situation where we should get a meaningful pullback. We have options expiration next week. It's also a short week. Don't know what's going to happen there. Then a week after that is the week before the Fed meeting. So things can get pretty hinky here. And the Fed has been very clear that they're not dissuaded in their mission to drive the Fed's fund rate over 5%. That is nearly a 20% move from here higher on short-term borrowing. And, eventually it's going to blow a lot of people up. And so I thought I wanted to share with you some of the why behind it. And you watch this open interest start at the fade here, then the market can't sustain it, because then you're fighting also the dealers, okay, and as well as the fundamental traders and the technical traders. The momentum people are going to get crushed.
Yeah, I agree. I think 4,000 on the S&P 500 is kind of a key level. If I will say this, a lot of times the move after the CPI will trend into OPEX. OPEX being Friday the 20th, coming up here of January. So if we do start getting traction over 4,000, then you kind of look toward 4,100 on the S&P 500. Not that we'll get all the way there, but it tends to support a trend. You lose 4,000, you're going to start looking down toward 3,900 on the S&P 500. So that's kind of like roughly where we are. It could go either way here. There wasn't much of a reaction off the CPI. It came in as expected. And so you can kind of make the argument that that was priced in. And so the safer thing would be to let the market kind of show its hand here going into Friday and into the weekend. And typically, Bob, right, 3-day weekend, the market magically levitates usually into those, and then you might get a pullback coming back on Tuesday. So we'll wait to see if we get that and go from there.
Yeah, I think that's probably likely to happen. And then usually that Monday where we're off, but the futures are trading, is usually when shenanigans happen and
right.
People goofy-footed into Tuesday.
Yeah, and if you guys want to see that, you can bring up a trading view chart and just type in ES, the symbol ES1, and that'll show you the futures. And you can actually see when the market's open before the first business day of the week. Normally it's a Sunday evening, 6 p.m. Eastern. You guys can open that chart up and just take a peek and see what the market's doing. Kind of clues you in that potentially Monday might be a green day or a red day. So just a little tip there as well. All right, guys, well, that's going to do it. Thanks for watching. Please hit like and subscribe. We appreciate all the views. Let us know your thoughts on this market. How have you guys been playing it? Do you think it's going to roll over here soon? I'd love to hear from you guys on that. And we'll see you on the next episode. Take care.
Trade Genius.